Now, AM 650 presents It's Your Money, an up-close and personal look at your finances. Here's your host, Fred Snyder.
Up in the morning and out to school.
Okay, we are back. Remind you once again, ladies and gentlemen, this is a live show. The first hour you just listened to was a replay. This one is live. We expect your participation in this show. We want to have conversations with you, our listening audience, about your money, but more importantly, about your money and how to keep it. We're ill-equipped when it comes to keeping money. They never taught us in school how to keep it. They taught us how to earn it, but not how to keep it. And we're going to carry on that show on this show and teach you a way to increase your financial IQ. So give us a call. Let's talk about your money, more importantly about your money and how to keep it. Suggest you get a pad, a pencil, write the numbers down. The number to call is area code 604-280-0650. Long distance is 877-280-0650. And for those who are shy, reluctant to talk on the air for any reason, read us down at the office, area code 604-737-3512. If you're calling long distance, it's 1-800-661-1495. Joining me, he's been here before, joining me today to talk about health, I talk about wealth, is Dr. Don Nexdorf. Don, introduce yourself.
Good morning, Fred, and good morning to your listeners. It's a pleasure to join you once again. I come here maybe 2 or 3 times a year, and our original idea for this was about health and wealth, because as people listening to us recognize, if you're not well, if you're still in the workforce, if you can't go to work, you may not be earning. And if you're not earning, that's going to cut into your savings and assets. And if you're retired, it's even more critical, as everybody's going to know, to take care of your health so you can spend those savings, and those savings don't go exclusively to your health costs. You're right. I'm a practicing chiropractor. I'm involved in a clinic here in Richmond that we have expertise in spine and back-related conditions since 1972. I'm also a former executive director for the BC Chiropractic Association and College of Chiropractors, and also participated in a number of other government things, which we won't have to get into that because I'll still be talking it for a while.
You were co-author of a fantastic book.
Yes, we were. The late Gary Bannerman and myself, I had the privilege to work on a project with him, which resulted in a book called Squandering Billions, Healthcare in Canada. We had to pick a country, so we picked Canada, but the reality is it doesn't matter which country it is. And the book, I'm pleased to say, has had great reviews and is utilized and sitting in several libraries of several ministries of health in Canada. And I think the best compliment we had from a reader was, I got so mad by the 5th chapter I had to stop reading for a while before I could carry on. So that tells us that we kind of hit the button on getting readers to sort of feel passionate about health and wealth and what to do about it.
Okay, proactive. It's the key word. Get passionate, get proactive about your health, and get proactive about your wealth. Imagine, if you will, if I said to you, I have this magic pill. We have this magic pill. You take this pill and you're going to live to be 130.
Yeah, you need some money to do that, don't you?
Okay, well, that's the whole point. I mean, imagine if you could live to be 130, but your money died when you were 80.
Yeah, well.
I mean, that's a bad scenario. You have to get them in sync. You have to get your health and your wealth synced.
And we know the Canada Pension Plan and provincial social services aren't geared to fund lifestyles from 80 to 120. But when you look at technology and different medicines impacting healthcare and better prevention, we're going to have to start thinking that, life expectancy is getting longer.
Well, there's no question about that. I mean, what's the number of people that are over 100 in Canada right now? I think it's 6,000.
Really?
It wasn't very long. It was not very long ago. It was 3,000.
Well, there's your evidence. So all of your listeners that are 60, 70, and onwards plan to live longer.
I have relatives that are in their 90s. You have relatives that are in their 90s, I believe.
I have relatives that are in their 90s, but in private practice, it's always interesting because when they talk about spine and spine-related conditions, they usually gravitate to the low back, and there's lots of data around that. But it's always amazing to me how many patients we have over 80 and over 90 that are coming in, which interestingly also goes back to the question that we're going to have a big economic problem in healthcare of the aging baby boomers. But when it comes to back and back-related conditions, we definitely see them, but just because you're 70 and 80 doesn't mean you're going to have spine problems.
So what's the best way to avoid spine problems?
Well,
what can you do about it?
the number one thing, just like you do with wealth, is learn about money, not just earning it, saving it, and how to keep earning and saving it and keep it.
So it's about knowledge.
It's about knowledge. And I give talks throughout British Columbia to Rotary and, for example, Rotary clubs in Vancouver Island, employers in British Columbia like Domtar and Kamloops. We provide a free service to organizations, employers, and any organization that has speakers. And our core message every time is real simple. You have a back. And why is that a simple message that resonates? Because people can't see their back when they get up in the morning. And if you try to lean over and brush your teeth, as some of our listeners have this morning, they will not have been able to bend forward because of back pain. And Fred, here's the key. Not you, I, or any one of the listeners said, "Oh my God, my fifth lumbar is killing me today." What's a fifth lumbar? Well, some
I
people
haven't got a clue.
Well, that's the point. And the point is real simple. You can't see the back and you can't feel the vertebrae. So that whole knowledge, just like you can see your teeth and look after them, that whole knowledge transfer is missing for the back.
So what about an MRI?
MRI is great, but there are several tools, diagnostic tools. So MRI is a diagnostic tool just like CT and X-ray. MRI will show you certain images as when there's some protrusion off to the disc, and those are things we employ only when the 80% that do get better fall into the 20% category that are struggling to get better, and then we need more information about why you're not responding to normal care.
Okay, so what can you do if you got osteoporosis?
Well, osteoporosis will be a condition where you're not having as much calcium in the body, and there's various tests that people can get to determine if they have osteoporosis. And it's approached from a perspective of exercise, diet, and then nutritional supplements. But osteoporosis alone is not always the reason that people have back problems. Spine problems or lower back conditions exist, and there are many other terms that people think they have. For example, I'll have a patient come in and say, "Gee, Dr. Don, I got sciatica. I don't have a back problem. I have sciatica." So there's a huge education gap as to clearly identifying cause, symptom, treatment, outcome.
And isn't there a clear parallel between that and wealth?
Huge. I mean, take, for example, the chronic pain. The World Health Organization updated their report in 2013, just last year. And the World Health Organization ranked the low back, and I'll get back to this in a moment here. I don't want to take away from the wealth part of the program.
No, it's no problem.
But the World Health Organization ranked low back as one of the 10 conditions that are facing the world population. So if you're experiencing chronic pain, you got up this morning, you made your coffee, you're either sitting there listening to us or walking around the room trying to loosen up that chronic pain, you're spending probably a good 2 or 3 days of your whole week coping with, finding remedies, spending money, trying to find ways to deal with it. Now, the good news is we actually do know how to help 80% of the people. It's that other 20% that struggle and carry on with lots of time and lots of dollars. I mean, just watch TV and you'll see an endless array of how to spend money on chronic pain.
Well, I'm a patient of yours.
You have been?
I have 2 shoulders, which have...
And I'm looking at them, folks. He actually has a right and a left.
Yeah, okay. And I have trouble with both of them, the rotator cuff.
Yep.
So what's your treatment for that?
Well, technology once in a while gives us some really amazing things. And a new technology, well, it's not exactly new. What is new is how it's transferred into daily clinical practice. And listeners need to start looking for clinics that offer what is called laser therapy, cold or low-level laser therapy. The results that we're seeing over the last couple of years are absolutely amazing in 2 respects. Frozen shoulder, and then we have the tennis elbow or chronic elbow pain, knees and ankles. For most of the people, and I preface this, nothing works 100% for everybody. But the most amazing thing is for these chronic shoulder problems, if the laser is going to help, the patients are reporting it starts to help within the first 2 sessions. Now, there are some technology differences here. So for the listeners, the real simple thing is, if you're not getting that sort of response within the first 2 laser sessions, take a look at whether or not that laser treatment is taking 20 minutes for every session, or if it's a different manufacturer and technology, that laser sessions only last 3 to 4 minutes per session. So in shoulders, we have seen up to 30 cases involving shoulders, elbows, knees, and Achilles tendons. And in each of those 30 cases, the people were telling us within the first 2 visits that their pain was decreasing. For those people who it did not help, this is the other good part, they didn't have to spend weeks and months trying to figure out, should I keep doing something 3 times a week for 5 weeks to see if it gets better. What we're seeing with technology, if it starts to help chronic or acute pain, it starts rapidly.
I had a trouble with my right knee, which was chronic for at least 3 years. I started going to you for treatment. It's better.
Yeah, knees are a great example. You'll find people from sports, and sports could start as early as teens, but you'll find people as we age will have knee problems, and it doesn't take very long to find someone with chronic knee pain, can't walk, they won't have surgery, can't have surgery, aren't candidates for surgery. Knee replacement and hip replacements are prevalent in society because technology now allows us to do that. But you take people with chronic knees and hips, that quality of life, their ability to work, their ability to walk, hugely impaired.
Well, I can't imagine being incredibly wealthy and incredibly sick at the same time. Life wouldn't be very good, would it?
Fred, I'm sure there's a lot of your people that you've helped with their financial planning, that around that financial planning, they probably have to put aside some thought, some time, and some money to deal with funds they need for chronic pain, because the public health system isn't going to be paying for everything, as we know.
So let's draw a parallel between health and wealth. And I think health, the issue starts, or to cure a problem, it starts with diagnosis.
That's right.
And it's the same thing with health. Okay, health and wealth, you need to diagnose the problem. So how do you diagnose the problem when it comes to your wealth? You need an MRI of your financial situation. You need an X-ray of your financial situation. Yeah. So what I want to talk about today, right now, is a assessment of a financial plan, a case study. Okay? So I'm going to put a case study up, and we'll wander through that. And there's a very distinct parallel between this and health.
Yes, there is.
A very, very distinct parallel. You've often said to me, to be wealthy, you have to pay yourself first.
Yep.
To be healthy, you have to pay yourself first.
It starts with you every morning you get up.
Every single time, okay? So let's take a look at a case study. So this is a case study. I put it up on the screen. So if you've logged on, it's www.am650radio.com, and then just click Watch TV, and you'll be able to see the screen and what we're talking about. If you can't do that, we'll try to paint word pictures for you so you can see what we're talking about. So essentially, I have to get this into play mode here, so pardon me for a minute.
Technology is great, but it always takes a few seconds to load up, and then we get frustrated when it's 5 seconds, not 2 seconds.
You got it. Okay, so here's the index, and here's what we're going to talk about first. This is an actual case study. So this is the overview of what this person had when they came to me. And this is one of many, okay? We're going to be doing these case studies on a regular basis. So this particular person had some GICs with Van City, had a RIF with RBC, $42,388, RBC common shares $50,000, total $155,249. That's what the client has to start with. That's just a big overview of the whole picture. Okay, so we're going to talk about this particular case study in terms of strategic asset allocation, the holdings that the client currently has in table form, same information in chart form, the geographical asset allocation. Hope I'm not going too fast and getting too technical, but that's how the money is invested on a geographic basis, how much is in Canada, how much is in the United States, and so on. The equity sectors, I'm talking about how much is in financials, how much is in material, and all that kind of thing. Style analysis, what's the investment style which is used in this particular case study? The annual returns, the compound returns, the growth of a $10,000 investment, how much risk and volatility is there, and the best and worst 12 months. Those are the issues that we're going to talk about in the case study. This is just the case study. Then after we do the case study, then we do a suggested portfolio as a replacement for that and compare it with a benchmark under the same criteria.
So income,
this is what you have to do.
But and return on investment and risk are two key elements of that, I suspect.
Very much so. Very much so. So again, Here's the strategic asset allocation of this particular portfolio. This person has international equity, 6.22%. Other investments, I don't know what they are, and it isn't very much, is 0.09. Canadian equities, 36.45. Cash, 42.68% of this client's money is in cash, and 14.56% in bonds. Now, this is an actual case study. How can this person make any money on a port? Look at the amount of cash. Getting 1%.
It's not going to keep up with inflation, which I think you're going to tell us about later, too.
Sure, no question. So again, strategic asset allocation, I'd like pictures. International equity is 6.22%. Other, I don't know what it is, doesn't matter. It's it's less than 1%. Canadian equity, 36.45. Cash, 42.68. Bonds, 14.56. Now, what's wrong with that picture? Okay. First off, it's not a very well diversified portfolio. It's extremely poorly diversified. Unless the guy needs that 42.68% because it's earmarked for some particular issue or whatever, way too much cash, not enough international equity, too much Canadian equity, not enough bonds.
Fred, let me interrupt you. Cash is pretty simple. We all know the definition of cash. It either jingles or it wrinkles. But when you see international equity and Canadian equity on your pie chart there,
Yeah.
what do those slices represent in terms of equity? And I guess specifically, when we talk to listeners and myself and other people, give us a sense of what is included in that word equity when it comes to investments.
Well, when we talk about investments, you really have three broad choices in a sense, but you can boil that really down to two. You're either a lender or you're an owner. When you're an owner, that's an equity investment. When you're a lender, you put money, you lend money to the bank. That's it in a nutshell.
Lending to the bank's sort of an oxymoron, isn't it?
Well, that's what they do. You lend money to the bank, and then they relend it at a higher interest rate and keep the spread.
Okay. So, but equities are things that you buy. So
equity you own.
Yeah.
Fixed income you loan. You're a lender or an owner.
What am I buying in Canadian equities or international equities? What's an example of something I'd buy?
Well, in Canadian equities, you'd be talking probably in Canada the big banks. Okay, you'd be talking about any large cap, blue chip Canadian companies.
Okay.
Okay, that's the essence of that. And there's not an awful lot of them out there when you really think about it. There's not a lot to choose from. International equity would be U.S., Europe, and everything else. That's global. So there's too much money in Canada and not enough money global in this particular scenario.
As far as the investment in that person's portfolio.
It's poorly diversified is really the key issue based on the surface, based on what I'm looking at here. So very poorly diversified.
How do we get to better returns and less risk?
Well, again, you got to modify the asset allocation. This is the strategic asset allocation. You should probably have certainly as much money invested in the United States and Canada. They should be roughly equal, I think.
Okay.
You should minimize the cash. You take the cash down to 5 to 10%, nothing more than that. You maybe should have 50% of the money in fixed income securities to mitigate risk. So I'd like to see maybe 25% of the money in short-term bonds and 25% of the money in long-term bonds, and then the other 50% split between Canada and the United States. Would be a better mix. It's a good place to start anyway, okay? So the bottom line is that the right answer to that question is not fixed. It's variable depending on the circumstances. But this is a way off base, what I'm looking at. Way off base. And it's a real case study.
So this is something you would change regardless of the sort of volatile nature of the world and national, international economies anyway. So this is the basic thing you got to fix.
Too much money in Canada, too much money in cash.
Because cash isn't going to get you any investment.
No. Not well diversified is your bottom line.
What do you say to someone who says, I'd like the cash just because I'm fearful that all the investments are going in the toilet?
Well, you got to convince them that there's more risk in taking that position than there is in a diversified portfolio.
Okay.
You see, you have to make risk your friend. You can't be stupid about risk. You can't overdo it. You can't invest in investments which are highly risky, but you have to mitigate risk. And you do that by picking the best funds and all that kind of stuff. If we look more specifically at the holdings this particular client has, we had our RBC Canadian Money Market Fund. You can look at the rates of return on that. RBC Select Conservative Fund and RBC Stock, 32.21%. And again, if you look at 5 years, there's your 5-year rates of return in that column right there. Okay. This here you ask about risk. There's the risk.
So we hope
as measured by standard deviation.
So we hope all the listeners have got their computers on and can see these tables too.
Yeah, because it's hard to paint a picture, a word picture of this particular example. Very hard to do.
What about the numbers there for anybody who's listening but they're not seeing? What numbers are significant if you're a listener right now?
Well, when we look at the RBC Canadian Money Market Fund, that's 40.49% of the whole portfolio.
Yeah.
And we look at the RBC Select Conservative Fund, that's 27.3% of the whole portfolio. And the RBC Royal Bank stock is 32.21. If you look at the 5-year rate of return, the stock is returning 11.68% compounded annually over the last 5 years. Stock's the best performing asset there. The Select Conservative is 6.91. The weighted return on 5 years of all those securities based on the percentage in each one is almost just shy of 6%. The 10-year rate of return is 5.15.
So in the RBC Canadian Money Market, what's the 5-year return on that?
In the money market fund?
Yeah, the RBC Canadian Money Market Fund.
0.41%.
But in the Royal Bank of Canada, it was 11. So the rationale for the Canadian money market, and listeners, I'm not a financial advisor. I'm asking Fred because I need to learn.
Yeah.
So the rationale for keeping the Canadian money market fund, is that just for security and to minimize risk?
There might be a special circumstances associated with that. In this particular case, there wasn't. Okay.
Yeah.
The client just didn't know.
Okay.
The advisor didn't advise.
So there's an opportunity missed there.
Yeah. Well, that's the problem. Okay. You get people that say, well, I don't want to take any risk, and I think maybe if I invested in kind of cash, I'm not taking any risk. But the risk you are taking is lost opportunity.
Yeah. Yeah.
So again, that's important to understand. So if we look at the holdings, if we look at that in a graph, there's a graphical illustration of that table right there. So you got the table cut up in three slices. 40% in money market, 27.3 in a mutual fund, and 32.21 in stock.
And this is a good case study now that you've shown.
Yeah, it's a real case study, yeah.
Okay. So 3 nice slices of cheese there.
Yeah. And then we look at the geographical diversification, which is very interesting. And this addresses your question earlier about geography and how much should be international and so on. If we look at the geographical diversification, this is what it looks like. There's Canada. There's the Netherlands, and there's U.S., and we got the table here on the right. My labels aren't all popping up here. But again, you can see the chart illustrates it quite well. But here we have 85.44% of the money's in Canada. UK 1.72, Netherlands 0.56, Japan 0.96, USA is only 7.18. We should be taking 20 or 30% off of the Canadian asset allocation, putting more money in the United States. Other countries, 2.67, Switzerland, 0.57, Germany, 0.9. Very poorly diversified.
So when you're going to improve on this, are you picking countries obviously with better economies, or also the tax consequences of having foreign investments?
Well, you gotta analyze that. Okay, I got analysts on staff that look at these issues and say, like right now, most analysts will tell you that we should have more money in the United States. Less in Canada, more United States.
And we hear lots about that economy, and 1 week it's doing well, 1 week it's unknown, and it keeps going back and forth like a ping pong match.
Yeah, true enough. So basically, important to understand that. Now if we look at equity sectors here, so here's a table here which says 82% of the money in that portfolio is invested in financial institutions. 3.4 is consumer discretionary. 3.4 is energy. 3% is industrials. Information technology is 2%. Material is 1.8. Healthcare is 1.5. I don't need to go on because basically the portfolio is way overweighted in financials at the expense of everything else.
Yeah, 82%. It's almost exclusively income driven from financials and their future.
Yeah. So therefore, the old classic is you don't put all your eggs in one basket. This is the classic putting all your eggs in one basket. Too much financials.
When you say financials, I assume that's traditionally, that'll be pretty much banks, or is there anything else?
Pretty much banks and insurance companies, and any kind of a financial institution, credit unions, etc. I guess you can't buy stock in credit unions necessarily, but the money is tilted in favor of financial institutions.
And would these typically all be in one or two countries, or spread around, or how?
This is the whole portfolio, whether it's spread around or not. That's the financial part of it.
But these financials will be in Canada only, or Canada and the U.S.?
No, it could be the U.S. too.
I see.
But the software we use to do this analysis tells us that. It doesn't take a single security. It takes all the securities and analyzes each security and gives you the total amount. So of all the securities that particular client owns, 82% is in financial institutions.
And you wouldn't advise that?
No. Why? Why do you think that would be poor advice?
Well, they're going to miss some return on investment in other sectors, and then they're putting all the risks in one area.
And what happens if interest rates go up and you're heavily invested in financial institutions?
Problems.
Do financial institutions do well when interest rates rise?
Well, they should. They get a little bit more money on their investments.
That's what everybody thinks, but it's not true.
Why not?
Simply because financial institutions borrow their inventory from savers and investors.
So they have to pay more.
So their inventory costs more. So their spread is squeezed.
Okay.
Remember I said earlier, they borrow money from the investing public, and they lend it to the borrowing public at a spread. So if their costs go up, they don't do so well. Financial institutions have done particularly well because we've been in a long period of benign interest rates. That's going to come to an end. We're closer to the end of that than the beginning by a long shot.
So how does this affect your case study?
Well, that pulls the numbers down because there's too much weighting in terms of financial institutions. That increases risk when we talk about it, okay? Like if I said to you, or most people, what do you think interest rates are going to do? What do you think interest rates are going to do?
Eventually they'll go up, but the problem is nobody knows when.
Okay. What's a good assessment of that? What's a good guess?
I would come and ask you that because I'm not even going to venture that.
I'm going to admit something to you right now. If you asked me 10 years ago what are interest rates going to do, I would have said they're going to go up. And they haven't.
Yeah.
I would have been wrong. And you cannot time the markets, and that's what too many people try to do. Too many people believe that you can time the markets. You cannot time the markets. Timing the markets is much like calling an election. Whoever would have thought that Christy Clark would have become elected? Okay?
Yeah, we've seen some changes in that in Alberta and British Columbia, haven't we?
Okay.
And Ontario's coming up this Thursday.
It's calling a turn in the market. The market is driven by sentiment. And you have to figure out who's going to win, the buyers or the sellers. And you can't do that. It's very hard to do.
Here's a question for you. I believe Ontario's election is coming up on Thursday. It's a huge chunk of Canada, as everybody knows. Sometimes people say it is Canada. So what might be the outcome to your portfolio depending on the outcomes of the Ontario election and the Ontario effect on economy?
Well, that, again, if we get a right-wing government comes in, that's good for business. So we get a left-wing government comes in, that's not. And good for business is good for portfolios. Bad for business isn't.
All right. So we'll wait and see.
You know, I think the issue when we talk politics, I often say you have to pick your politicians wisely. Okay? So if you're picking politicians, you have to say to yourself, how good a steward of my money is this politician going to be? Okay? So if that politician is going to engage in deficit spending and run deficits up, run the cost of borrowing up, put the country further in the hole, that's not good for business.
And in our society, in the North American society, the politician can be the woman or man next door.
Yeah, you got it. That's exactly right. But too many people don't understand that markets are driven by sentiment. You got have fundamental analysis and technical analysis. Technical analysis is sentiment. Fundamental analysis is what are the numbers. So you analyze a company, you look at the numbers, the balance sheet, the income statement. Are those numbers good or bad? If the numbers are good, that doesn't necessarily mean that people want to buy that stock. If nobody wants to buy it, the stock isn't going to perform well. So if you need both, you need to analyze fundamentals and you need to analyze the sentiment. You can't do one or the other. You have to do both, and you can't time the markets because you can't predict sentiment.
So you've balanced you reviewed the case, you reviewed your client's portfolio. You found there's some changes to be made, and you've rebalanced the sectors that they're invested in. What happens then?
Well, you have to select investments. You need a machine. You need some type of a process for choosing investments. How do you choose investments? What kind of software do you use? How do you figure out, for example, I want to have the top Canadian equity investment fund in the portfolio. I want the top U.S. fund in the portfolio. I want the top European fund in the portfolio. I want the top long-term bond fund. I want the top short-term bond fund. What's the criteria that you use to pick those funds? Now, there's all kinds of ways. You can go into Globe Fund and you can pick only funds that are rated 5-star. That might be one way. Or you can say, I want the best fund, the best performing fund last year. I want the best fund what's the best fund that performance-wise over the last 5 years? What's the best one? Now, I use 5 years. I say, okay, what's the best performing fund over the last 5 years in each category? And I have a way that I can do that, and I can do it fairly quickly using software.
With the software, I think technology is probably one of the huge assets in your profession to give you so much granular data from so many sources. But one thing strikes me, and how has that analysis included or factored in the huge swing of the collapse around 08-09? Because when you say a 5-year average, when we look back, the reporting will be to December 2013 or the first quarter of 2014. Sure. So by nature, we're going to capture 2008 or 2009. And from 2008 to 2009, the tide has lifted, so pretty much most of the ships have come up too. How do you find the real value in those sectors other than the tide just came up?
Well, maybe you switch to 10 years, and you say, which is the best performing fund over the last 10 years?
So those who survived the 2008, 2009 debacle and then also have done extraordinarily well now.
Yes. You know, it's all analysis. It's all judgment. It's all taking a look at what a fund has done. If a fund has a good 5-year track record, it's probably a good fund. It may not be always. That may not always be true, but most of the time it is. And if you pick a top-performing fund over the last 10 years, it's got to be bang on because it was through one of the worst market periods that I've ever seen.
What are your favorites now? Do you have a speculation as to what you see the favorites going forward?
I'll come back to that after we go to the break.
Fair enough.
So hold on to that question, and we'll come back right after this message. Don't go away.
Fred Snyder.
I want people to call the show that are genuinely interested in increasing their financial IQ so that they can become financially independent sooner and stay financially independent longer.
Fred Snyder.
You don't have a blueprint. Imagine trying to build a house without a blueprint. And how about having a blueprint for your life? What are your lifestyle goals? You need to think about your family life. What are your goals about your family life? What are your lifestyle goals when it comes to health? What are your lifestyle goals when it comes to finances, mental and spiritual? You have to set goals in all those areas, not just finances.
Fred Snyder.
Often we fail because we put too much emphasis on one area and ignore everything else. We work our butts off and we ruin our health. So life is all about balance. So you need a life plan.
Fred Snyder.
Napoleon Hill says this, wrote the book Think and Grow Rich. Anything that you can vividly imagine, ardently desire, and enthusiastically act upon will inevitably come to pass.
Fred Snyder.
My goal, my mission is to help people enhance their financial IQs by teaching them what they need to know to make better financial decisions.
Fred Snyder. Sunday mornings at 9 on AM 650. This is CISL Vancouver. All-time favorites. AM 650. Welcome back to It's Your Money on AM 650. If you have a question for Fred, call 604-280-0650. Now, back to Fred.
Okay, we're back. We're live. We're interactive. Remind you once again, ladies and gentlemen, and listeners out there, we are doing an MRI on an actual case study. This is an actual client. Names have been removed to protect the innocent or whatever. But the bottom line is that this is a real case study that we're looking at. The numbers are true. This is the situation. So, Don, you had a question just before we went to the break. I think you were asking me what funds that we would select.
Yeah, which would be the favorite ones? I mean, in your profession, do you have a speculation as to, and I realize the speculation going forward, but are there some that with data that may stand out today?
Well, like it's very, very, in fact, it's very, very clear and easy to identify your top performing funds. But you have to have a criteria. You have to have a selection criteria, some way that you can define, this is why I picked this fund. I often say to people here on this show, you should be able to put your investment statement on the table in front of you, close your eyes and drop your finger on any one of the investments in that portfolio and say, this is why I own this particular fund or this stock. This is why I own it. If you can't answer that question, you need that question answered.
Yeah.
You need to, and 99% of the time I sit and talk to people just like we're having a conversation across this table right now, and I say, tell me about your investment plan. And they look at me with glassy eyes and say, duh, what do you mean?
And then if someone says, well, why do you have that investment plan? Because I trust Fred Snyder.
There's an awful lot of that in there. That's exactly right.
Yeah.
There's a lot of trust in there. And I think that people need, I'm flattered if people trust me, but I think that people need more information to make serious investment decisions.
Yeah.
I don't think that they should just kind of throw the ball out there and say, here, I trust you. You give me, you set this portfolio up the way you think is best. Okay, that's called discretionary trading. You can find yourself people that do what I do that have the authority to do discretionary trading, and they just move your money around at will.
That's right. There's a difference. That's not investing.
Well, no.
Well, not in the long term like what you're doing.
I don't move money around without the client's permission, and that's important. Let's talk to Kelly from Tawasin. Kelly, welcome to the program.
Kathy.
Pardon me, Kathy.
Okay, I'm sorry. I thought
no problem.
was waiting online. Hi.
Hi there.
I just got a quick question for you, Fred. I'm thinking about retiring, but I'm not sure about how feasible that is. I'm only working part-time, and I don't have an outside pension. I've worked, I'm coming up 64, but I've put all my investments with the Bank of Montreal a couple of years ago. I still have $42,000 in investors, but because I didn't want to pay a fee to take them out. So that's sitting there. I'm not sure exactly what that's in. I'd have to look. But with Bank of Montreal, I got about $216,000, and he's invested it in BMO Select Class Security Portfolios, the majority of it, and balanced portfolio. So I guess what I'm looking at for is it says a rate of return of 6% of the top one and 9.5% of the second one. But is that where I should be? Should I be at this stage in my life?
Are those returns since inception or just current?
It just says returns. So maybe
So that could be the return, the total return that you made in the last 3 years, or it could be the total return that you made in the last month.
I think it's a quarterly statement, so I believe that, I guess, and my investment guy moved from Tawasin branch to downtown, so I really haven't got anybody to kind of go over this stuff with.
Well,
Even though I've got an accounting background, it's still kind of foreign to me, all this stuff.
You should, you're a typical person who needs an analysis of your portfolio.
I do, and to see am I on track? What should I be doing? When will it be feasible for me to actually quit work? I was thinking 65 when I have both my pensions. Mm-hmm. I took my CPP early at 62 because I was out of work in between the periods of time. You
made a comment that you had money with investors.
Well, that's where my portfolio was to begin with, but they kept it just really wasn't increasing at all.
And you didn't want to take it out because you had to pay a fee to take it out.
Yeah,
but you see, by staying, by staying there in underperforming investments, you're also paying a fee to leave it there. Because
so
if by taking it out and investing the money properly, you'll quickly recover the fee, because that fee to get out of it is a one-time thing, whatever that fee is.
Yeah, and it's based on when you went in.
Yeah.
It's kind of locked in. There's a word, I've got the terminology, but I understand it. But
it's usually called a deferred sales charge.
The DMO, he was fairly young, and I really think I need somebody with a little more experience and that understands where somebody that's in their 60s.
Well, I was with investors for 24 years, so I understand investors really well.
Pardon?
I said I understand what investors offer and what they do very well, because I was with them for 24 years.
Yeah, and I went in when I had a friend that I curled with and she stayed in touch with me a lot. But when she retired, I of course I was in Victoria, because that's where I lived for 20 years. But I didn't feel that I was getting the same kind of personal attention, and Well,
you need, Kathy, was a financial plan ever prepared for you at any time?
Yeah, Christine from Investors did something about 8 years ago, maybe when I was around 55.
Well, what you need today is a written financial plan. If you make an appointment to see myself, I will prepare for you at no cost or obligation a written financial plan. I'll do an MRI on your investment portfolio, and I'll show you the difference between keeping what you have right now or moving the money to something that's more productive.
I think that's what I need. I'm feeling that I'm just kind of floating, and I just need more of a plan. So, yes, I will do that. I just need to jot down...
Call Frida right now. You can get Frida at 604.
Just a sec. 604.
604-737-3512.
Just repeat that.
Okay, 604-737-3512.
What was it? Kind of cut out.
Okay, I'm going to repeat it again. Maybe, okay. It's area code 604-737-3512.
Okay, it was the 3 I was missing. 3512.
That's it.
Now, you're downtown.
That's correct.
Do you have any other places that, or do I have to go to your office?
Well, it's better to come to the office, because that's where all my tools are. But if you can't, then we can make other arrangements.
Yeah.
I for example, on Wednesday, I'm going to Nanaimo.
Yeah, I work 3 days a week, and I'm also involved with our golf course. I'm the captain, so I'm a pretty busy person. But I have Fridays off, so I will try to arrange something.
Well, Kathy, I really appreciate your call. Don't forget to call Frida.
I've been listening to you over the last 3 years, and I thought, I think I'm going to give him a call.
We'll make arrangements for you.
Okay, thanks, Brad.
Okay, Kathy,
Bye.
you enjoy the rest of the weekend. Bye for now. Ladies and gentlemen, listeners out there, if you just joined us, that line is now open. Haven't got a lot of calls here today. I guess we haven't been giving the numbers out enough. I'm going to give them out right now. Write them down. Give us a call. We're running out of time. We want to talk to you about your money, more importantly about your money and how to keep it. And the number to call is area code 604-280-0650. Long distance, 877-280-0650. And again, if you're shy or reluctant to talk on the air, Frida's down at the office, area code 604-737-3512. Long distance, 800-661-1495. Give us a call. Let's talk about your money, more importantly about your money and how to keep it. And I'm talking with Don Nexdorf. We're talking, Dr. Don Nexdorf.
Dr. Don's good.
We're talking about money and health, really. Health and wealth. They go hand in hand. Like love and marriage, they go hand in hand.
You want to be well to enjoy your earnings, and you want to be well to create earnings. Fred, let me go back to something that I heard you say to Kathy a moment ago from the caller from Tsawwassen, and you mentioned no cost, no obligation, and of course that's huge. But it also made me think about something else I've heard you talk about in the past, and that's one of the costs of investment portfolios is the cost of the investments themselves. In other words, there are costs to everybody's labor, and yours, mine, and all the listeners too. So how much might the cost of investing impact the portfolio? And are there always costs with all the investing? And if so, who's paying those costs? So it could be substantial, an annual cost.
Well, let's suppose that I have an investment fund, a mutual fund. I can pick any one of 2,000, 20,000 that are out there. Every single one of those funds has a money manager. Every one of those funds has somebody managing that fund that's deciding what to buy it, when to sell it, that kind of thing. Now, that person can't work for nothing. I wouldn't want somebody managing my money unless that person was being well compensated for what they were doing. So every investment fund has what is known as an MER. It's a management expense ratio.
Right.
That's what it costs to run the fund. Those fees are not billed directly to the client. They're billed to the fund itself. But indirectly, the client pays them.
Sure, because it's reducing the value of the fund by the fee paid to the manager.
That's exactly right. So consequently, people talk about MERs. Some say, well, they're too high. Some say they're not high enough, and so on and so forth. There's a lot of misinformation about MERs. But the published numbers, the numbers that I'm using here today, are net of MER. They're after the MER has been applied.
So what happens if I have a portfolio with you? Are you charging me an annual fee for those investments that we make, change, trade, or manage when my portfolio changes?
I could, but I don't. As a matter
You
of
don't?
policy, I don't do that. I could charge a front-end fee, 2% up front, that kind of thing. So which means you pay 2% before you start, so you're starting at 98% of whatever you're investing. I don't do that either. I have an early redemption fee schedule that I use, which means if you redeem more than 10% of your account in the first year and a half, you pay 3%. In the second year and a half, 2%. After that, 0. And you can withdraw up to 10% free at any time.
So that's going to improve my investment portfolio, because in some cases the returns are going to be sometimes slim depending on the market, the investment. But if I don't have fees that I have to pay the investor or my manager, mainly you, that improves my return on my investment every year.
100% of your money is working on day one, and you're not locked in. But there is an early redemption fee.
Sure.
I mean, I want your money for 3 years.
Yeah, so if I change my mind, naturally I'm going to pay you something. But if I leave my money with you, which I will because my return on investment is good, I'm not paying you a fee every year.
That's correct.
That's a good thing.
I think so. I think it's the best of all worlds. But again, I can't work for nothing or 0. Neither can the people who are managing the funds.
Well, I'm going to assume that someone else is paying you, and as long as it isn't me and my returns on investment are good, I'm happy.
Yeah, you're
I
right
don't
on.
need to know who's paying you as long as I'm not and I'm making money.
Okay, 604-280-0650. Long distance, 877-280-0650. Log on, www.am650radio.com. Free to down at the office. Area code 604-737-3512. Long distance, 800-661-1495. I'm here with Don, Dr. Don, next door, Dr. Don. We're talking about your money, more importantly about your money and how to keep it. And we're doing an MRI case study on an investment scenario. This is an actual live case study. So we just looked at the equity sector weightings, and you can see the graph right there. Look at financials. I mean, this is putting all your eggs in one basket.
With that case study, do you know or do you recall what that return of investment of that portfolio was doing?
I'll come to it in a second. It's coming up.
Okay, because we got to let everybody know that.
I know. Oh, yeah. I struggle with whether I'm going to put the rate of return first or last. So anyway, case study, the style analysis. I'm going to just flip through this fairly quickly so we can get down. This is style. So I got these various graphs. And here we have Canadian bond type. So we were talking how much should be in fixed income. 52% of this portfolio was in long-term government bonds. 48% was in corporate. Nothing here. Market maturity date, mostly developing, only 1% in emerging economies. Fund equity style, non-applicable 100%. Equity market capitalization, 92% large cap, 2% mid cap, 6% non-A, and small cap 0. I want to get to returns, and you're going to love it here because here it comes. There's your returns. There's your annual returns on the portfolio.
Before you changed it? Or is this the
one?
one?
This is the actual case study.
Yeah. Wow. Well, you better give those numbers in case they're not watching their screens.
So in this particular case study, the return in 2013 was 8.56%, 2012 was 6.88, 2011 was 0.53, 2010 was minus 0.31, 2009 was 20.42, 2008 was minus 11.76, 2007 was minus 0.64. The worst was minus 11.76. Okay, so again, that portfolio isn't going to create financial independence. It can't. It can't possibly do that. And if we look at the compounded rates, which is more significant because this is what the client actually experiences.
And those numbers are...
So if in answer to your question regarding the recession of '08, the 10-year rate of return is 5.15.
Yeah.
The 5-year is 5.97. 3-year is 1.1. These are the compounded rates. 1 year is 8.65. Year to date is 1.71. Last 3 months is 2.54. Last month is 0.16.
So this is a case study of a portfolio you would not recommend.
No, that's what they already have.
This is the one they came to you with.
Yeah. I mean, if I were to attach a number to this portfolio, and I would say if 10 is great and 1 is lousy, I might give it a 2. Okay, it's not a very good portfolio.
Well, listeners absolutely need to pay more attention to this because every day we see the rising costs of inflation in the form of gasoline.
Yeah.
I call it a death of 10,000 pennies. I mean, every time gas prices go up, the ripple effect through the economy is staggering and hidden, but the net result is we need to pay attention to these compounded returns.
You have to. And you know, all I'm looking at right now, I'm not looking at the benchmark, I'm not looking at the replacement portfolio. I'm only looking at what they have right now. We just got that far and we're almost out of time. So basically, if we look at this is more revealing than anything. There's a grid. And if we look at that grid, this is the case study growth of a $10,000 investment in that actual portfolio. I should almost start
over what 10,000 over what period of time?
10 years. 10 years.
10 years. 10 years. $10,000.
So if I take a look at this here, and I say, how would that $10,000 have performed? This is very revealing. And maybe I should start with this slide when I do this presentation the next time. So this is the growth of $10,000. 10 years. There's the first leg. 10,000 went in. Over the first 4 years or so, it went up to 14,000. Not bad. Okay, now watch. That's almost 5 years.
Yeah. So it was extremely vulnerable to 08, 09.
Well, it was at 14,000 at the beginning of that red line. At the end, it's still 14,000.
Yeah. So with inflation, everything else, you're going backwards
for 5 years. Okay. Now, there's the last leg. 14,000 here, up to 16,000. Let's take a call. Let's talk to Robert from Vancouver. Robert, welcome to the program.
Good morning, Fred.
Good morning, Robert. How you doing?
Great, beautiful day.
Oh, is it? I can't see. The blinds are closed. Yeah, it's looking nice out there.
Our situation is pretty good. We own a condo, and my wife's thinking about buying a townhouse in the Port Moody area and renting it out. She's an American, and she's moving half of her IRA over. Do you think it's a good investment over the short term or long term?
Well, your question really is real estate a good place to invest right now? Real estate's always a good place to invest, but as long as it's not all your eggs in one basket. Okay, I think that everybody should have a portfolio which includes fixed income, includes equities, and includes real estate. There are almost 3 different asset classes in a way. Real estate is not the same. It's an equity investment, I know, but it's not quite the same as stock.
Yes.
And I don't know enough about the rest of your circumstances to be able to give you that assessment on the air. What you really need to do is come in and get yourself a financial plan prepared, second opinion on your investment portfolio, and go from there.
I hear you, and I like the idea of not putting all of our eggs in one basket.
I mean, you know, the word seems to be out there right now that the Chinese people that have been buying property here in Vancouver and running real estate prices up through the roof, that may be over. we had a collapse, a bubble. There was a real estate bubble in the United States that caused the recession, essentially, that we had. It didn't quite happen in Canada at that time, but it did happen in 1981 in Canada. I remember in 1981, I had a house in the village in North Vancouver that I paid $98,000 for 2 years prior to that. And in 1981, it was worth $250,000 in November of 81. In a month, that value of that house dropped from $250 to $180.
Ouch.
Okay, and fortunately, I didn't have to sell it. If I'd bought that to sell it, I lived in it, so it didn't really matter to me. But that's what happened. My equity took a big kick. And at the same time, I had a $25,000 line of credit with the Bank of Nova Scotia that was called in November of 81.
What were the interest rates then?
Oh, interest rates were through the roof. They were. Yeah. I had a 6% mortgage in November of 81 that came due at 18%.
Ouch.
Three things. The perfect storm in 1 month. Bingo. And the credit line wasn't called because I had poor credit. The Bank of Nova Scotia, they said we're calling all of our credit lines because we've loaned money to Latin America and they've defaulted and we have to fix things. So, and they said you don't have to pay us off. We're just going to refinance your credit line with a consumer loan at 18%. So that's called the perfect storm. And it happened to me in 81. Now, if it happened in 81, there's nothing to say it couldn't happen again. So, ladies and gentlemen, and again, Robert, don't put all your eggs in one basket. Don't bet the farm on anything. Spread it out. That's the trick. And people need to understand how to diversify. Like I could do a whole show on that particular topic. When we invest, what we want to do is have positively correlated investments and negatively correlated investments to balance each other out. One's going up, the other's going down. For example, now this isn't always true, but most of the time is true. If U.S. stocks are going up, gold is going down, and vice versa. What's happening today? U.S. stocks up, gold down. That's predictable almost. There's negative correlations between real estate in Vancouver and real estate in Toronto. There's negative correlations between equity investments in North America and equity investments in Europe. So you got to design a portfolio with those correlations, and you need a professional to help you do that. It's very hard to do on your own. Does that make sense?
It does, and thank you for your time.
Okay, and if you want to take it to the next level, give Frida a call down at the office, area code 604-737-3512.
Thank you very much, Fred.
Come on in. I'll be happy to give you a written financial plan and second opinion in writing on your investment portfolio. Appreciate the call. Enjoy the rest of the weekend. Bye for now. Okay, Don, we're out of time.
Fred, thank you very much. It's been a pleasure joining you and your guests this morning, or listeners. They're guests too.
How can our listeners get a hold of you, Don?
The listeners can call the clinic 604-271-6442, 604-271-6442. They can also check out the website, dnixdorf.com.
And remember, ladies and gentlemen, Frida's down at the office. She'll be down there all day. You want to make an appointment to see myself, you can call Frida. She's down there right now, area code 604-737-3512. And thanks for joining in the show today. Really appreciate your calls. Take care. Bye for now.
If you'd like Fred to review your portfolio, call his office right now at 604-737-3512. That's 604-737-3512.